What is going on, guys? Today I'm going to share with you how to build a watch list and pick the perfect options contract for each stock. What you never want to do is copy me or any other trader. Only focus on the stocks you know from a fundamental and technical standpoint. More importantly, you are aware of the upcoming news and events that could be both positive or negative for that sector and stock. What I will suggest for every trader is to keep SPX and NDX on their watch list, which is the S&P 500 and the NASDAQ 100. Knowing how these major indexes perform intraday is crucial as they will directly impact basically all of the stocks on this watch list. Also, we don't want to trade counter trend. So what I will suggest as well is TNX, which is the Treasury 10-year note. Typically, it moves inversely to equity. So we saw it was down on Friday, NDX was up 150. You could also use the VIX. People know when the VIX is up, the market's down. You could use DXY, whatever floats your boat. These are not necessary. I just like to suggest them. Now, the first step in picking stocks is to identify the intraday volatility for each ticker, better known as the ATR, which is your average true range. Now, how do you find the ATR? I like to go on finviz.com and we would simply type in some names from our watch list. Let's use Meta, for example, and we would go down to the ATR, which is the average true range of the past 14 trading days, and that would be 23 points. Let's do Tesla. This one is 19 points. We could do MSTR, 29, very volatile. Coinbase, 17 points. Palantir, 7 points. Nvidia, 7 points as well. Let's do one more. SMCI, perfect. 5. So it gives us a fantastic range. We saw 5 points all the way up to 30. Now, this is going to be crucial when picking the options contracts. I see way too many people with NVIDIA, they'll start the week. NVIDIA's at, let's say 120, and they want to buy like the 150 calls, but the ATR every day is 5. It would have to trend up every single day and almost more than the ATR on average, which again is just so unrealistic. So if I was to pick option contracts and NVIDIA was at 120, I'd be looking for like the 110 to 115 puts max, 125, 130 calls max. I wouldn't be going any more than that unless it's earnings week or you think it's going to be extra volatile. But that's crucial. I think that's a big thing that most people don't look at, and they blindly buy contracts that are so far out of the money, and 1 or 2 days goes by and those contracts get fried and they have no idea why it happens. So now we're going to take a look at Tesla here. We know that the ATR is 19 and change. We're just going to call it 15 to be conservative. The price is at 262. Let's just call it 260 again for clean numbers. So if I'm going to look for calls, I'm going to add 15 to that. So I'm going to look somewhere in that, 275, maybe 280 range for calls. And then on the put side, we look somewhere at that 250 to maybe the 245 for puts. And again, if your tolerance is different than mine, if you want to be more volatile, more risky, that is completely fine. But those are going to be my levels that I'm going to focus on right off the bat without looking at the options chain, without looking at the past week of trading, anything like that, just purely based off of how it's been moving in the past 14 trading days on average. So now what I would do is go on the 5-minute chart and I'd look to say to myself, okay, well, I know I want to be at 250 to 245 and I want to be at 275 to 280. When was the last time the stock traded there? Last session on Friday, we saw it bounce aggressively at 250. It ripped all the way up 14 points, pretty much made this V-shaped like recovery, and that will be common across the board. So we're seeing strong buying demand at 250. That's a great sign. On the flip side, we saw the end of session on Wednesday into after hours, then pre-market Thursday before spilling down, before spilling down, was trading at $280. So we know that it's realistic for this week, the next 5 days, for the stock to trend near that 280 range on the bull side, near that 240, 250 range on the bear side, based off where the price is trading currently. So now what we want to do is look on the options chain itself, and what I would do is look at that 250 to 245 puts. So I'm just going to put a box right there, and then on the call side, 275 to 280. Volume and the open interest on both the call and the put side. I think that's important, just knowing where the liquidity is going, where buyers are placing their strikes. And again, when we look at the open interest and the volume, 46,000 volume traded here at the 250s, 35,000 open interest, by far the most liquid on the chain, which is a great sign. And then again, these are trading somewhere at that 525 range. So what I don't want to do is I don't want to buy something, let's say, for example, at, 255. Okay, because again, it just doesn't make any sense for where we're at. 6, 7 points down, you're paying $700 a contract. For me, it's just not worth it. Same thing on the call side. We do notice that 32,000 volume here, 15,000 open interest is one of the most liquid on the entire chain. What I would say has a little bit more volume is the 265s at 37,000. However, you're paying $9 for them. It's just simply not worth it. For what? A 3, 4 point move up? The ATR is 19 and we're being conservative calling it 15. So on average, it's making a 20-point move. You're telling me you only feel comfortable risking 2 to 3 points? It doesn't make any sense for me personally. I'd want to be somewhere near the money, but not that close to the money, just in terms of value. You want to buy a $3, $4 contract and see it go 12, 13, 15, 20. Okay, so you could see very clearly with Tesla. Let's do it for one more. Let's do it for Meta, and we'll see the same exact thing. If we're at 625, we know Meta's ATR is like 23.86. We'll call it 20 to be fair, and the price is at 625 currently. So on the call side, we're going to be looking for the 645 to 650 calls, and then on the put side, we're going to be looking for the 605 to 600 puts. And I think the 650s and the 600s are probably going to be the best slot without looking because they're whole numbers, they're clean numbers, and we saw on Friday the same thing like Tesla, that V-shaped recovery, massive bounce off of 600. It ran all the way up 28 points. Again, from the top there, it fell 35 points, then reversed another 28 points. This is crazy, crazy volatility as you could see in Meta. This is why you can get a little bit more juice out of these contracts. This is why it wouldn't make sense for you to buy like the 630 calls or the 620 puts. It's way too expensive. You want to buy contracts that are somewhat cheap and be able to get 3 to 5x minimum. So as we did before with Tesla, we would look at that 6 to 605 put side, and then we'd look on the call side somewhere in that 645 to 650 range. So same thing that we'll look at, the volume and the open interest. We'll do the same thing on the put side here. And what we're observing, 5,600 volume at the 600s, 2,300 open interest. This one looks like the most liquid on chain. Again, that whole number there, you'd be somewhere at 580 to $6 a contract. Okay, if you want to be a little bit more risky, that's fine. You can go 595, you can go 590 for cheaper. I personally don't like that. On the call side, again, all matters on your risk tolerance. I think the 640s have a lot of juice, 5,000 volume, 4,100 open interest. The 650s, 10,000 volume, 2,300 open interest. These are somewhere at $5. If you want to pay 10 points more, you're going to pay somewhere between, $8 a contract. So $3 more on the contract for 10 points. You tell me if that's a fair value or not in the section below. But again, personal preference. I like near the money, not too far out of the money, not too close to the money. If I'm paying this much for a contract, doesn't make sense. But again, I don't want to be at 675, 680, where I'm now 50 points away and I need 2 or 3 consecutive bullish days or 2 or 3 consecutive bearish days. That's not good odds for only 5 trading days. And again, you have to be smart. So let me know in the comment section below if you're enjoying breakdowns like this. I'm trying my best to make it simple, straightforward, and to the point so that anyone can understand it no matter what level of experience they are. And again, when we look at the actual watch list itself, what am I doing? Essentially, I'm just taking the stocks and matching up the correct contracts with each ticker, the same way that we just did the video. Here's Tesla, 280 calls, 250 puts, very simple. And then the same thing here for Meta, right? We have the 650 calls, 600 puts. What I'm going to do is I'm going to take this data and I'm going to compare and contrast the bid, the ask, the volume, and the low and high, which is essentially the range of the contract. I want to compare that intraday. Where did it open at this week? Where did it open next week at the same exact strike? Now, let me give you one example that I'll leave you off with. I think this is going to be very important. Let's just use Meta for example. We're going to compare 3 separate weeks. So we'll do Meta 1 week, Meta 2 weeks, and Meta in the 3 weeks. Okay, so let's just say we open the week at $600 for 3 weeks straight, unchanged. Now, this is very unrealistic, but again, it's just easy numbers so that you'll understand it. Now, every week when we open on Monday, we're going to look at the value of the contract 10 points away, 20 points away, and 30 points away from the money. And in this case, just for clean numbers, we're going to say it opens the week every week at 600 flat. So for this week, let's say Meta opens and I look at calls that are 10 points out of the money and they're trading at 3. 20 points is at 2, 30 points is at 1. Now, next week goes by, 7 days from now, we open up and now these are 350 and these are 250 and these are 150. And then now the next week, another week from there, these open up and they're 450 and 350 and 250. Okay, this is going to be a very good sign that is indicating a potential big move on the underlying stock to the upside or downside, depending on what contract you're tracking. Now, if you're not paying attention to this, you're not going to be aware of that fluctuation on a week to week basis. So that's why I can make a mental note. I could simply just take a screenshot here and boom, now I have my list and I could just put it away for the week. And then I could pull this up next week and look at the same thing. So if Tesla now is at 280 by the end of this week and I'm preparing for 7 days from now, now I could do the same thing. Okay, well, I had 260. I was looking at the 280s. So that was 18 points out of the money. Now let me look at 280. Okay, now I'll look at the 300s and see where they're trading at. And let's say these open the week at 4, and now I look 20 points out of the money, and now Tesla's 450. That's a mental note I'm going to make. Okay, and then the next week, let's say the same thing. It's at 320. I look 20 points out of the money. It's the 340s are now 500. Okay, that would be a great sign there that the plus 20 is keep going up each week. Simple, easy, to the point. I don't want to get you too confused here. I don't want to say too much at once. That was my quick breakdown there. Hope it made sense. Any questions or concerns, let me know in the section below. If you enjoyed this video, consider sharing it with a friend. Smash that like button if you enjoyed it. Click subscribe if you haven't. And of course, please enable those post notifications so you don't miss any crucial updates on this channel. Again, guys, have a fantastic day. And as always, we'll see you in the next one.